Good morning, monsters. One of the stocks on my watch list today that I have is this one, Navient, symbol NAVI. The stock is trading at $11.97, up a few pennies, doing not much on the daily chart. If you look at it, it basically made a lower high here, a lower high here, a lower high here, and here just below the 200-day moving average, it is stalling again and making a lower high. Most important thing is that if you look over here, the MACD turned bearish, stock sell off. The MACD turned bearish after making lower high, stock started to roll over. The MACD turned bearish once again, and stock continued to sell off. And now once again we have MACD turning bearish, and the stock might be stalling here and might be ready to go straight down. You can see the same picture in RSI as well. RSI rolled over, RSI rolled over, and here RSI is rolling over. So what is interesting about this stock? Now, first of all, this is a student loan servicing company. So all the federal loans that are provided under the Federal Family Education Loan Program, FFELP, as well as the private education loans, the company services those loans. So if you have student loans, you probably know this company very well. You probably make payments to this company every single month. Now, interesting thing happened. Right here, if I go to intraday chart, just about 20 minutes ago or something, you will notice the stock spiked down hard on very high volume from 1205 to 1175 before bouncing back a little bit. What happened here was right here. If you go to Twitter, you'll see Elizabeth Warren, the senator. You can go and look up her on the tweet on Twitter. Senator Warren is the Sen Warren is the Twitter handle. She started presenting a new bearish case for the student loans program. She's been tweeting this non-stop. So they're all from today. All these tweets are coming out today. So here's her new plans: 5 fundamentals for the Department of Education to fix student loan services. There's also a YouTube video attached over here. So,
when a private company breaks the law.
Okay, well, you can take a look at it later, but you can see, if you can just go to Twitter, you can continue to the YouTube and check out what she has to say about student loan servicing program. Elizabeth Warren is not the only one. If I go to my market digest right here, back on February 8th, I mentioned this in my chat room. February 8th, Clinton was slamming a student loan servicer, Navient, as misleading, according to Reuters. So, if I go here, and I open what Clinton had to say, this was on February 8th, here is that article from Reuters. And you can see, right here it states what's going on. Navient is being investigated by Consumer Financial Protection Bureau over late fees and other matters, the company revealed in August regulatory filing. So here you have Senator Warren trashing the stock this morning, and Clinton was out in February trashing the stock this morning. Now keep in mind that this is the political year. Elections are this year, so everything is on the table. We saw what the political rhetoric has done to the biotech sector since last summer. So what is to say we're not going to see the same kind of reaction in in student loan servicing stocks when you have when you have the leaders in this country basically getting involved over here. So let's close this. Now, take a look at what's happening in short interest. If I go here, you'll see that Navient short interest is only 6.2%. That's not big, right? But here's what you're seeing in the short float right here. See, this is on March 15, which is the last reading we had. It jumped to 21.2 million shares. But look at the progression here, basically in the last 1 year. I mean, this thing has quadrupled, from 5.5 million all the way steadily rising, and it's just jumping millions of shares every single month. And the current student loan total short float stands at 21.2 million. So there are lots of bears that are leaning against the stock, even though the daily chart has on short covering rally probably a little bit, but the chart has rallied a little bit with the rest of the market and is now possibly stalling again just below the 200-day moving average, and MACD is starting to roll over. it caught my attention today just before Senator Warren, or just after I should say, Senator Warren started tweeting all that information out. Right here, somebody came out and bought 3,000 of May 10 puts for 30 cents. They paid mostly 30 cents offer side. There wasn't much bid in this. I mean, the bid was actually 5 or 10 cents, but they came out and they bought 3,000 of these at 30 cents offer. And then they came out, also bought 900 of these in the last 10 minutes or so, made 12.5 puts for $1.20 offer. So they're saying that, with Clinton coming out in February and Senator Warren coming out in March, this rally will not hold. And this stock is going to start to roll over from here, and they're looking for downside. Earnings are not scheduled yet, but looking at when they released the earnings the last time, my expectation is sometime at the end of April. So sometime after April expiration, you're going to see some earnings come out, probably end of April or early May. Here's another note I wanted to show you. Now, of course, the Wall Street, always likes to downplay some of the bearish thesis that's coming out. Here is one from BMO Capital. This was after last earnings report on January 27th. And this is basically what I want to focus on right here. Following revised guidance from management, we lower an NAVI core EPS forecast down 8% in 2016 to $1.88 from $2.05, and down 13% in 2017 to $1.96 from $2.25. So, 8% decline, 8% earnings cut in February, 13% earnings cut in 2017. What were the main reasons? The main reason was net interest margin on private loans is basically turning in the wrong direction, and you have a mismatch between the rising rates, LIBOR before prime. So that was the basis. But then again, they still go on, this is BMO Capital, they still go on suggesting they still like the stock. They see 60% upside in Navi shares. They have a $16 price target while they are cutting estimates, which makes no sense to me. To show you another example of that, if I go right here and, if I go to earnings, come on. If I go right here, you'll see the earnings projections and how they're playing out. So here, this is fiscal year 2015. You can see the earnings estimates right here, 2015, 2016, 2017. They were cut back in March last year, then they were cut again in the summer last year, then by the end of the year it was cut again, and then after the reported earnings in January it was cut again. So earnings are coming down drastically. You have political rhetoric starting with Senator Warren and Hillary Clinton going after the company, calling it misleading. There's an official investigation going on, which has started about a month and a half ago, about the late fees and charges from the company. You have put buying taking place right here in May, and you have a chart that is technically probably right here stalling, and now it's starting to turn negative. I mean, if I look at the intraday chart, right here is starting to come back down. So you have a chart that is stalling here with MACD and RSI rolling over, and short interest is rising. So how would I play this? The simple logic is, you have to, in my opinion, if we're going to basically make a bearish case on a stock that is basically is being attacked in the political hemisphere, you want to make sure that basically your idea of buying puts goes several months out, simply because you want to be able to see this play out as the time goes by, because elections are going to be sometime, convention is going to be in June, and then elections are going to be in November. So in this particular case, I like buying straight, going all the way out to January 17, and buying straight 10 strike puts right over here, which will cover all the politics that's going to happen between now and then. With the stock trading at 1190, obviously these puts are not cheap, relatively speaking, because these puts are trading for, let's call it 90 cents is the bid, ask is $1.40, so maybe you'll get a fill around 120, and that means it will still require about 18-20% decline in the stock from here for these puts to even go in the money, and you would still be spending about, let's call it about 11-12% of the underlying. So these puts are not cheap. So in fact, probably a better idea is to go with in the money puts. January 17, 12.5 strike puts, which are in the money. That's bid is 2.15 and the ask is 260. You can probably get a fill around 240. Buy those and tuck them away. The delta on these puts is 0.5, which means every dollar move to the downside in the stock is going to expand the value of these put options by 50 cents. And so if you're looking for a stock to fall below 10, these puts are eventually going to start commanding, like, you know, because the delta will also increase as the puts go deeper in the money. So, you know, these puts will probably expand to 4 plus over time, but you have to take a long-term view, because in this particular case you're making a bet about political political noise is going to get worse and worse as the time goes by. So that's one of the stocks I'm looking at. A lot of things are playing out over here. All my notes. Oh, by the way, one more quick thing before I leave. Back on February 25th. Here are my notes. This is my chat room from February 25th. You can just go to Market Digest and pull that up on the website, and you'll see exactly the same thing. This was the first time in a long time I discussed this stock, and here was my question. Can you guys find any good chart of student loans delinquency and default rates? I wonder if Sallie Mae and Navient will be able to survive in quarters to come. I wasn't joking about that. I was serious, because I see a significant disconnect with student loan default rates rising sharply while everything is going down. So that's what I was asking, and Chris was making a comment right over here, and this is what I was able to find out. So you see, here's a percent of balance 90 plus days delinquencies by loan type. So what you have seen since the Great Recession ended, you have seen credit card default rates come down, mortgage default rates come down, auto loans, aside from subprime. I know auto loans are mostly also, the default rates are down. Equity line of credit is down. But here's student loans. You've only seen this go up and up and up and up, along with student debt. I mean, there is a big disconnect in the story, and the two stocks that are in the front of this entire thing is Navient and Sallie Mae. I'll show Sallie Mae chart in just a second too. But you can go to February 25th and read my read my note right over here. Here is Sallie Mae chart. This one has sort of stabilized, and let's see if it breaks out from here. But chances are, if Navient goes south, you're going to see Sallie Mae also go south. But right now, the put buying is in Navient. So keep this one on your radar. I like the play, but you have to take a long-term view. Probably a better play is to buy January 17, 12.5 strike put. So right here is 12.5, right here. All right, so you're buying in the money January 17, 12.5 puts for about 240 or less. And so they're already in the money, and you're looking for this to gradually go south, and who knows, it may even just go bankrupt. I'm not joking about this, because if the government's they're servicing government loans, federal government loans, and if the federal government loans is coming after them on late charges and all other kinds of stuff, this may continue to crash. Those forward earnings estimates don't matter, and besides, they're already coming down anyway. So keep an eye on this chart. I think there's a lot much worse to come for this. And that's all I have to say. Thank you.